This chapter 3 describes a number of applications for repo and reverse repo transactions and how pricing is affected by particular structures and motivations. The first and perhaps most common application for repo is to provide financing for the seller and a secured investment opportunity for the buyer. Sellers in such instances are typically dealers in government or corporate securities looking for cheap funding against the positions they hold. By repoing their holdings for a day, a week, or longer, they obtain financing on relatively cheap terms and often in an amount that is almost equal to the value of the underlying position. We will see in a moment that the buyer typically prices a repo in such circumstances cheaper than an unsecured loan to the seller, since the buyer under the repo also has recourse to the collateral if the seller defaults on his obligation to repay the original funds plus accrued interest at the maturity of the repo. Indeed, it is typically the case that the repo rate is slightly lower than the Fed funds rate, and thus substantially lower than LIBOR or the commercial paper rate for highly rated issuers. Large dealers of fixed income securities often obtain tens of billions of dollars in financing via the repo market, whether on an overnight basis, open basis, or for terms ranging from a few days to a year or longer. Indeed, during the meltdown of 2007-8, repo as a funding tool rose from 10% to 50% of total funding for some institutions. And with pressure from regulators to lengthen the maturity of bank and FI liabilities, term repos are growing in market share while the overnight market is beginning to shrink. Closely associated with this first application is the use of repo to implement a carry trade, so-called, which is something bond investors are attracted to when the yield curve is steep. Assume the 5-year U.S. Treasury yields 5%, while the 1-month repo rate for these securities is 3%. By purchasing the Treasury note and then repoing it for a month, the investor earns the difference between the 5% yield on the Treasury note and the 3% financing cost for the entire month. This is referred to as positive carry. At maturity, she intends to close out the transaction and sell the Treasury note. Of course, the profitability of the transaction will depend on what has happened to the price of the Treasury note during the first month. If rates have not changed significantly, especially around the 5-year point of the curve, the Treasury notes can be sold at close to their original purchase price, and the proceeds used to pay the repurchase price under the repo. But if rates for that tenor have risen substantially, the fall in the price of the Treasury note may be greater than the gain achieved via the positive carry. If the investor is unwilling to sell the Treasury note at such a loss and expects rates to rise no further, or even to reverse direction soon, she can choose to keep holding it and to finance it for a second term in the repo market once again. We come to a third repo application, this one driven more by the buyer than the seller. Repo, or more specifically reverse repo in this instance, makes it possible for a dealer or investor to short securities in the anticipation that their price will decline. Suppose in the example above that a dealer expects the price of the 5-year Treasury note to decline from par to 98 over the next month due to an expected increase in medium-term interest rates. assume there is no accrued interest on the Treasury note and that neither party requires margin from the other. The dealer enters a reverse repo, pursuant to which he purchases the 5-year Treasury notes and pays $10 million for them. With the repo rate at 3%, the two parties also agree that in 1 month, the seller will repurchase the note on the repo maturity date for an aggregate price of $10,025,000, approximately. Since she now owns the Treasury note, the dealer turns to the bond market on the left and sells these notes at par. Because the buyer here has insisted on particular bonds as the underlying securities for the repo, the transaction is said to involve specific collateral, as opposed to the more classical forms of repo we saw earlier, in which the buyer cares only that the underlying securities meet overall eligibility criteria, where we would speak of general collateral instead. If a month later the dealer's forecast has come true and the notes are indeed trading at 98, ignoring the accrual of interest on these notes, the dealer purchases back notes equivalent to the ones she had sold a month ago for $9.8 million and delivers them to the original seller under the repurchase leg of the original repo, receiving the $10.025 million originally stipulated. Her profit from all this comes to $225,000. Now suppose the short seller is particularly eager to short a specific Treasury note that is in short supply, and the others are also eager to short. The heavy demand for this bond in the repo market enables holders to negotiate a better repo rate than the general repo market rate at this point in time. Since it is the seller that pays repo interest on the funds obtained under the repo, this means the seller is able to negotiate a lower repo rate than the general repo rate in return for agreeing to deliver the specific Treasury note requested by the buyer. For example, if the general repo rate for 1 month is 3%, as before, the seller might be able to negotiate a rate of 1% in return for delivering the specific Treasury notes, thereby obtaining financing against this position at a 2% annualized interest savings. Specifically, this means the seller will sell the Treasury notes for $10 million to the buyer and will agree to repurchase them for only $10.008 million and change, instead of the $10,025,000 in the earlier example, representing a savings for the seller of some $16,000 and change. For this to make sense for the buyer, she must expect the Treasury notes to decline in value by more than $16,667 during the 1 month period after she shorts them in the market. The difference between what we have labeled the normal repo rate of 3% and the 1% rate that applies to the specific Treasury notes under heavy demand is reflected in market practice by the terms general collateral and specific, or sometimes special, collateral, as we saw earlier. And practitioners talk of a particular bond or security as being unspecial when it is under such heavy demand that the rate applied to repo involving these bonds becomes substantially lower than the rate for general collateral. It is perfectly common for the repo rate of a bond on special to be several percentage points below that for general collateral. And indeed, in recent times, when short-term rates have been so low, repo rates for bonds on special have sometimes become negative. In other words, the buyer purchases the specific bond at a particular price and resells it to the seller at maturity at a lower price, in effect earning a negative yield on his funds during that time. We have established so far that repo is a convenient tool for financing a long position in securities, while reverse repo facilitates short positions. Our next application therefore involves so-called relative value trading, in which a dealer or investor goes simultaneously long and short two securities, whether issued by the same entity or not, in the expectation that their prices will converge or diverge. Assume, for example, that both the 5-year and 10-year T-note are trading at par when the curve is upward sloping between those 2 points. Specifically, the 5-year has a coupon of 5%, while the 10-year has a coupon of 7%. An investor expects the yield curve to flatten between those 2 points around the 6% level in the next month or so. If this happens, the 5-year will trade down in price to around 96, while the 10-year will rise in price to around 107. If the investor is long the 10-year and short the 5-year, his gain from these price movements would be close to 11% of notional. So, using repo and reverse repo, the investor goes long the 10-year note while shorting the 5-year note. Specifically, and again assuming no accrued interest or margin requirements, he purchases the 10-year note for 100, repos it, and gets back 100 in repo financing, uses this 100 to reverse repo the 5-year note, and sells this 5-year note for 100 in the market. The repo of the 10-year note requires him to repurchase this note in 1 month for approximately 100.25, and similarly the reverse repo of the 5-year note requires him to resell or return this note in 1 month for approximately 100.25, assuming in both cases the 1-month repo rate is 3% annualized. A month later, if his expectation has come true, he purchases the original 5-year note in the market at 96. Of course, this has become a note of 4 years and 11 months to be more precise. Delivers it for 100.25 under the reverse repo second leg, and uses that money to repurchase the 10-year bond for 100.25, which he now sells into the bond market for 107. When all is netted out, our investor has achieved the profit of $11 estimated earlier. We next illustrate how the repo market can facilitate the market-making activities of an interest rate swap desk. We assume first that the 5-year T-note again pays 5% and trades at par. The 1-month LIBOR is 3.5%, while the 1-month repo rate is 3%. Assume finally, just for a moment, that this 50 basis point gap between LIBOR and the repo rate for 1-month tenors is guaranteed to remain in place indefinitely. The swap desk has been asked to enter a 5-year interest rate swap, IRS, in which it would receive 1-month LIBOR and pay fixed for 5 years. The desk enters the swap, then hedges itself by purchasing the 5-year T-note and repoing it at 3%. His position on day 1 looks as shown in the diagram appearing now. If the dealer is prepared to just break even on the trade, he would quote 5.5% on the fixed leg of the swap. The 2 arrows at the top of the diagram would then lock in an annualized loss of 50 basis points for the desk, offset by the 50 basis points in annualized profit from the 2 arrows at the bottom. ignoring differences in day count conventions. The 50 basis point excess of the 5-year swap rate versus the rate on the T-note reflects exactly the 50 basis point excess of 1-month LIBOR over the 1-month repo rate. And since LIBOR is almost guaranteed to exceed the repo rate, given that LIBOR reflects unsecured funds while repos are secured, this virtually guarantees that under normal market conditions, the swap rate will exceed the rate on a T-note of equal tenor. In reality, the swap rate in our example above would be adjusted on account of two important considerations: the profit margin of the dealer and the fact that there is no assurance that LIBOR will continue to exceed the repo rate by 50 basis points until the termination date of the swap. Of course, as a practical matter, the desk simply waits until a second counterparty comes along, this one wishing to enter a 5-year swap in which he pays fixed to the desk, say at 555, and then unwinds the repo position and simply uses the new swap to offset the original one. We turn next to the use of repos by central banks. An entire module on this topic could be written, but we limit ourselves here to mentioning that central banks often use reverse repo mechanisms to inject liquidity into the banking system and sometimes to enable financial institutions to monetize holdings that have become illiquid and incapable of being funded in the normal interbank or securities markets. Starting with government securities, a central bank eager to inject liquidity into the system would purchase these securities from designated banks and dealers and resell them later at a pre-agreed repurchase price that includes interest at some repo rate. As with private sector repo transactions, the central bank will typically insist on some minimum margin, which varies with the quality of the collateral and with the perception of current asset liquidity and marketability. In the meltdown of 2007-2008, a number of central banks in the Western countries, including the Fed and the ECB, expanded significantly the eligible securities they were prepared to repo in to offset the massive diminution of liquidity in the normal interbank market, often accepting for the first time various kinds of complex asset and mortgage-backed securities. Indeed, this development caused many banks to securitize their consumer loans, then to retain the ABS issued out of such securitizations rather than attempting to sell them into an unreceptive market, and finally to repo them with their central banks to re-inject necessary liquidity into their balance sheets and operations. Our final application of repo describes the so-called matched book. The best way to understand the matched book concept is to view repos and reverse repos as simple money market instruments, with the dealer making his money by quoting a two-way bid-offer spread. So if, for example, our earlier 3% 1-month repo rate is in fact a mid-market rate for general collateral, the dealer would quote 295.305, the 295 being the rate at which he is prepared to take in funds for 1 month and deliver general collateral, and the 305 being the rate at which he is prepared to lend out funds and take in general collateral. The general collateral delivered under the first leg may not necessarily match the general collateral taken in under the second leg. But of course, both types of collateral need to satisfy the eligibility criteria stipulated in the governing documentation. Indeed, the dealer does not really care what the underlying securities are for this purpose, only that they be of sufficient credit quality to secure his position should the party borrowing funds default at any stage. Must maturities on both sides be identical in a matched book? Once it is recognized that the repos and reverse repos in the matched book are merely money market instruments on which the dealer makes a bid off a profit, there's nothing to stop the dealer deliberately mismatching maturities to take advantage of the shape of the yield curve on the short end. In short, the dealer can implement any of the classical funding and gapping strategies that the money market dealer implements with unsecured funds, including strategies that benefit from a rise or fall of the curve, or ones that rely on a curve steepening or flattening. This means that the term matched book is really a misnomer, since the dealer in such instances may well be matching the dollar amount of repos and reverse repos on each side of his book, but not their tenors. Yet the expression is still commonly used in such instances. We have concluded our discussion of the applications of repo and reverse repo, and conclude this chapter 3 by discussing repo pricing. This is more art than science, and fundamentals often give way to technical considerations as to which we cannot generalize much. The following rules, however, should normally hold. The lower the credit quality of the collateral, the higher the repo rate. The less liquid the collateral, the higher the repo rate, although this is also addressed often by increasing the margin. A right of substitution provides a convenience to the seller and increases the administrative burden for the buyer, so the greater the number of permitted substitutions, the higher the repo rate. Of course, the repo rate changes dramatically when the collateral is special, becoming several percentage points lower, as we have seen, when the collateral is in very short supply. The lower the margin, the higher the repo rate. A cross-currency repo should be more expensive than a classic repo involving a single currency. We discuss cross-currency repos in Chapter 4. A hold in custody repo should be more expensive than a regular repo since the buyer assumes greater credit risk. Finally, a tri-party repo should be cheaper than a hold in custody repo, but still more expensive than a regular repo. That being said, there is doubt the market prices repos efficiently in all instances. Consider an investor who is choosing between a 1-year unsecured deposit and a 1-year term repo. Assume the deposit would be with a single A-rated bank whose default probability over 1 year is estimated at 0.1%. The alternative is a repo with a triple B rated bank using uncorrelated triple B rated collateral, where we assume the margining arrangement effectively eliminates any price risk regarding the collateral. We also estimate the default probability over 1 year of a triple B rated entity to be 0.5%. As to choose between these two options, many market participants would opt for the first on the basis of the higher counterparty rating than either the counterparty rating under the repo structure or that of the collateral. Yet simple mathematics teaches that given the zero correlation assumption between counterparty and collateral, the probability they both default equals 0.5% times 0.5%, which is 0.0025%, which makes the repo 40 times less risky than the unsecured deposit. If such a simple example confuses many people, imagine how much more room for confusion exists when we introduce positive correlations between collateral and counterparty, margining arrangements that do not always work perfectly, and other complications of various sorts. This completes this chapter 3 and brings us to the end of this module's part 1 as well.